Hey guys, welcome back to another video. Today I will be covering a topic which I am very passionate about. I publish a lot of research on Seeking Alpha, and whenever I am researching a equity, I always build a discounted cash flow model. And whenever I'm doing that, I do find myself always improving my technique and really improving the accuracy of my projections. And throughout the years in which I've been publishing my research, I've come to really see that there are a lot of common mistakes that students and entry level analysts at the investment banks and equity research shops, they make a lot of common mistakes, and there are 4 common mistakes which I'll be covering in this video, which will really help you improve your overall projecting skills, your modeling skills, okay? So before we begin, I think it's actually important to first understand what the DCF model does. First of all, if you're watching this video, you should know how to build a simple discounted cash flow model, but we're even going to go simpler. We're going to go all the way to the very core of what a discounted cash flow model does. So imagine that you are the owner of a local restaurant. How do you value your business? How do you judge whether it is performing well or not? Well, at the end of the day, if you are a business owner, the most important thing to you is cash. You have bills to pay, you have your mortgage to pay, you have to put your kids through school, college, and those tuition payments, you need cash to make those payments, right? So if you are the owner of a business, for you, what matters most is that that business is generating cash for you to pay for your livelihood. Now, just as owners value their businesses, equity investors are business buyers, and thus the source of value comes from the same thing, cash. So how much does the business generate today, and how will it grow its cash flow? These are some of the questions that business buyers and business owners ask themselves. They ask themselves the same questions. So even though, equity analysts wear suits, at the end of the day, they are business buyers. So they are invested in that business, and they should be thinking the exact same way as the business owner, right? So cash is most important. Now, the objective is to buy a stream of cash flows for less than it's worth. And that's what the discounted cash flow model does. It values that stream of cash flow and judges whether it is overvalued or undervalued relative to the public price of that stock. So instead of using proxies like a multiples projection, the DCF is the most fundamental and accurate technique when considering the value of a business. And so this is very important to understand. At the very core, if you are able to use a model, if you are able to use a discounted model, I would value it as the most accurate projection of that value for that business. Of course, some businesses will see that they find themselves in a value trap in the market, but that's besides the point. When you're looking at the value of a business, if it's generating cash and it's generating sustainable cash, then that's a strong business, and you should therefore buy it. Okay, so now let's actually get into the mistakes. So mistake number 1, probably the most common one, is that usually in the discounted cash flow model, the forecast horizon is too short. So many analysts assume that projecting cash flows beyond a certain period, usually 5+ years, is suspect to unknown longer-term trends, and therefore shorter forecasts are used. The mismatch between the short forecast horizon and asset prices that reflect long-term cash flows leads to investors compensating for the valuation gap by adding value somewhere elsewhere in the model. This mismatch is usually solved by adding a terminal value. Now, does that make sense though? Well, consider the restaurant. Would projecting three years of cash flows out be enough to fairly value the business? How accurate will the terminal value be in capturing the actual value of the business? So if we're going back to that restaurant, well, if we just project out individually that on a year-by-year basis for the next 3 years, the business will generate X, Y, and Z, and then just throw in a random last 12-month multiple and multiply it by the EBITDA of the last period, it just doesn't make sense. At the end of the day, we're looking at the pure cash that is generated, not a multiples projection, not a terminal value projection, right? So really, if you can extend it as far as possible, if you can extend that forecast horizon, then the accuracy of your projection improves, and therefore you are valuing the cash that business generates more accurately, okay? So The recommended changes are the forecast horizon should be no less than 7 years and usually extend to 10 plus years. And the forecast period should capture at least 1/3 of the corporate value. So the final projection price of your discounted cash flow model, 1/3 of that discounted price needs to come from the individual year-by-year projections of that cash, discounted to the present. If more than 2/3 of the value is originating from the terminal value multiple, then it just doesn't make sense. You're depending too much on that multiple, and you're not really allocating enough, emphasis on the year-by-year projection of that cash that the business generates. Okay. So let's consider an example. So I recently did completed a research report on the Canadian-based diamond producer Dominion Diamond. And so the company has two mines, Ekati mine and the Diavik mine. Now, thankfully enough, especially in the mining industry, companies have to project their cash flows out until the reserve base ends, right? Until they really fully exhaust the ore that is available in each of their respective mines. And so what the company does in their investor presentations is they actually provide you a projection of the cash flows of that business out till actually 2034. So and this is a very easy example, but for mining companies especially, the forecast horizon for that discounted cash flow model, there's no excuse for you to project out 5 years alone. You should be projecting out to the final year that the company has provided. In this case, they know best. Of course, there are questions whether, management are lying to you or not. But at the end of the day, they are responsible for reporting clear and accurate assumptions of, this is the expected cash flow from our aggregate assets. And so if they are projecting out till 2034, then you can confidently project using your discounted cash flow model out till 2034 as well. And so this is an easy solution, especially in the mining sector, to really build out your models beyond the usual 5-year period. Okay. Now, mistake number 2 is something that I feel a lot of people don't understand, and that is the uneconomic continuing value. So building off mistake number 1, recall the fundamental principle in microeconomics. Over time, competitive forces assure that the return on investment will equal the cost of capital. So remember in your microeconomics introductory class, in the supply and demand, looking at that market, if there is profit in the market, then people will want to enter into that market and capture that profit. It makes sense. But over the longer term, if there's existing profit, then people enter the market. If there's actually negative profit, then people exit. And eventually, over the long term, what you see is that there is zero profit. And so that also makes sense when you look at long-term growth. When you're assuming a long-term growth rate of 2%, what doesn't make sense? If the market has a long-term growth rate of 2%, well, then businesses will enter to capture that 2% and eventually increase the amount of supply and drive down the profitability of that industry until really what happens is that you have your return on invested capital equaling the weighted average cost of capital. So that's very important to understand. Right? So another way economists define this is through the use of the term fair rate of return. So usually what happens is, from a financial analyst, they always judge a fair rate of return, the opportunity cost of that investment. The opportunity cost of any investment is the next best alternative. So the next best rate of return. And so that's really considered the fair rate of return. Now the fair rate of return over the long term equals the weighted average cost of capital, because once again, you get paid to take on that risk, which is the cost of capital, but no more than that. Right? So that's very important to understand. So in order to account for the valuation gap from a short forecast period, analysts usually add a continuing value estimate, right? Unfortunately, the model fails to reflect a clear sense of the company's timing of value creation. So what happens is usually the explicit forecast period where we project the year-by-year cash flows, a lot of that value is not created in that explicit forecast period. Instead, what happens is that terminal value, which is calculated at the end of the model, really makes up majority of the value projection, right? But assuming that terminal value, what a lot of analysts do is they assume perpetual growth. They assume that a long-term growth rate of 3 or 4%. Once again, when you're focusing on research, which research has proven this concept, at the end of the day, if there's long-term profit opportunities, companies will enter that industry and capture that profit, therefore driving down until you get a fair rate of return, which equals your cost of capital. So there is no real long-term growth. So instead what happens is that, going back to this example over here, really the explicit forecast period, the value creation should be right in this area, but the long-term value, so the terminal value, should actually drive down and close out to the weighted average cost of capital. So really the core of your projection comes from the explicit forecast period rather than the terminal value. Okay, so that's really important to understand. So here's a food for thought. So the common method used to fill in the valuation gap is the exit multiple method. So you take the last period of EBITDA and you multiply it by the last 12-month EBITDA multiple. Now, say, for example, the EBITDA multiple is 13 times. Well, this implies 6% earnings growth and a 150% return on incremental capital in perpetuity. No company has ever achieved that, and it just doesn't make sense from a purely logical perspective. Now, of course, in some instances, purely logical is not the best approach, but when you're looking at the research and the longer-term trends, at the end of the day, research shows that over the long term, this doesn't make sense, and really, the model is inaccurate. Okay, so segregating the model into a period of value creation and value neutrality can capture the continuing value with a perpetuity assumption. So going back and looking at how it should be, the explicit forecast period should capture majority of the value, while the terminal value should really capture the continuing value perpetuity assumption, which eventually closes out to equal the weighted average cost of capital, the fair rate of return. Right? So to deal with this perpetuity assumption, usually the Gordon growth method is used. So usually what you learned in class is to take the free cash flow, the last free cash flow of the period, multiply by 1 plus the long-term growth rate, and divide by the difference between the weighted average cost of capital and the growth rate. Now, the problem with this solution is that you're assuming the company's return on capital will be more than the cost of capital. But microeconomics and research shows that over the long term, that's not true. The weighted average cost of capital will equal the long-term growth rate, right? So what we actually need to do is we need to correct our formula. And so instead of using the Gordon growth method, to fully account for the key principle that return on investment equals the cost of capital in the long term, we can take the NOPAT, net operating profit after tax, of that final period and just divide it by the weighted average cost of capital. Now, this often represents 60 to 70% of corporate value. It assumes that the return on any future investments will be zero. And that's in line with what we already were talking about in mistake number 1. 2/3 of our projection value is okay to come from the terminal value, but the other remaining third should be coming from our explicit forecast period, right? But when you're talking about assumptions, the Gordon growth method deviates away from what research has proven to us. Okay? Now, mistake number 3 is a mismatch between assumed investment and earnings growth. So in order for any company to grow, investment via working capital, capital spending, acquisitions, and R&D must be done. Analyzing the return on investment helps determine how invested capital turns into earnings growth. And so the formula for return on investment, ROI, is the net dividing the company's net profit by investment, right, in that respective period. Okay? Now, many analysts underestimate the investment necessary to achieve an assumed growth rate. One common mistake is projecting earnings for a business that has been acquisitive in the past. When calculating the growth rate of earnings, simply projecting out the working capital needs of the business will be insufficient in actually calculating the cost of this earnings growth. Okay? A quick solution is to add a ROI line in the model to calculate if ROI is consistent as the business's earnings continue to grow. To check for any error, if the ROI line is rising or dropping without a thoughtful explanation explaining this deviation, the model is incorrectly projecting the capital needs of this business. So let's pause and let's kind of go over this once again. So mistake number 3 really talks about how some analysts, when they're projecting the investment, the capital expenditures line in their discounted cash flow model, they under project usually. Because what happens is when you're looking at a business, and I'll take an example that I was actually I recently released some research on, liquor stores. It's a retailer that retails alcoholic beverages in North America. And so this company six and a half years ago made a huge acquisition. And so that acquisition was accretive to earnings over a longer period of time. It didn't, impact earnings directly 1 year later. What happened is they really took a lot of time to really integrate that business and really have a significant impact on earnings. So what happens is if I were to look at only the 3 years before my starting projection period, I would look at, okay, investment spending has been significantly low, but earnings has been growing significantly. 5% compound annual growth rate. Wow. Okay. So if investment's increasing at 1% and earnings have been increasing at 5% compound annual growth, then that means that I can continue this. Well, I should be looking even further back and realize that they made a $500 million investment in this business, and they acquired a significant amount of retail stores before, and so eventually that impacted the earnings growth, while investment spending declined significantly as they completed that integration, right? So the solution to that is to implement that ROI line and really extend it back historically and into the future. And so here's the example. So one of my early DCF models, I've removed the name just for simplicity's sake. So the ROI line in the historical example was right over here, and then my initial projection period started at this moment, right? And so I projected earnings were going to continue to grow at 2.3% compound annual growth, and I assumed that investment was going to grow at a significantly lower level. Now, returning back to this model, inserting this ROI line, I saw that the investment needs, they just didn't make sense. This volatility didn't make sense in the projection, and that's once again because I did not account for the acquisitive past of this respective company. I needed to look back at how earnings were impacted by previous acquisitions that were not fully reflected in the investment and capital spending needs in the previous 3 quarters or 4 quarters, right? So that's really important, and a lot of analysts make this mistake. Okay, so mistake number 4, the final mistake, covers scenarios and sensitivities. So probably the most common flaw in DCF's models is the sensitivity of valuations and how a small change in assumptions can lead to large changes in valuations. So actually, this comes from the same model that I took this ROI line from. So I looked at the sensitivity analysis that I had completed for this respective DCF model, and I actually looked at the numbers. So I didn't just look at the center number which I was projecting, but I looked at how the sensitivity impacted the projection. And so look at this. So looking at a gross margin of 25% and going down to a gross margin of 24.5%, the valuation changed by $6. The terminal growth stayed the same, and a 0.5% change in gross margin impacted the projected value of this company by $6. Does that make sense at all? Of course it doesn't. How could a half a percent change in gross margins impact half the valuation of the company, half of the market cap, $500 million? That just doesn't make sense. So whenever you really finish your DCF model, you complete the sensitivity analysis, a good check is to look at the numbers and see how incremental changes impact the overall valuation. What would make more sense is if, that 0.5% dropped the projected value by maybe 50 cents or $1. That's reasonable. But if 50% of the projected value disappears just by a 0.5% incremental change, that just doesn't make sense, and something is wrong. Either this number magnifies the impact of cash flows, or there's something in the model that there's such a core dependence on gross margins that really every other factor that's included in that model really doesn't account for that valuation, right? So that's really important to understand. In addition, another big thing is looking at what we're actually displaying in the sensitivity model, okay? So just focusing on this thing one more time, one of the things that a lot of students will do whenever they're answering case studies is they'll look at a sensitivity analysis and they'll put the weighted average cost of capital and the terminal growth rate. Okay, and that's great for you because you've looked at the model, you've built the model yourself. But from an external perspective, that's not very valuable for someone who's coming and looking at the model for the first time. I don't care what your weighted average cost of capital was. I care about the actual business and what the projections were. So in this case, instead of projecting terminal growth, which once again is incorrect, because remember, we're assuming that the long-term growth rate equals the weighted average cost of capital, right? So what I really would care about is the gross margins. I'd care about, investment expansion, so the capital expenditure expansion. So target and really display the sensitivities of line items above the free cash flow line rather than below it. The moment that you go below it, the moment you focus on long-term growth and the weighted average cost of capital, a lot of the errors that can be made have already been made. So what you're really displaying is useless information. And so this is what usually happens when you display that information. You see these big changes in valuation due to incremental gaps, right? So some quick solutions to improve these big changes is, of course, to lengthen the forecast horizon and also make clear perpetuity assumptions. So cover mistakes number 1 and 2. In addition, although many DCF models include a sensitivity analysis displaying changes in cost of capital, growth, or terminal value assumptions, they are irrelevant to any outside analyst. Sensitivities should illustrate value drivers, presenting the sales margins and investment needs of the business. So really, you need to focus on factors affecting items above the free cash flow line. Factors below that magnify the impact rather than actually influence what is most important in the model, projecting the cash of the business, right? So what, the value triggers that you need to focus on are sales, operating costs, and investments. If you can project, the sales growth or operating costs, the marginal cost of the business, or the expansion of capital expenditures, and you display that in the sensitivity analysis, then you're actually communicating important value in that sensitivity analysis, because you're saying, okay, if the business is going to be more acquisitive in the future, if they're going to invest more in the business, how does that impact the valuation? If earnings are going to fall, then how does that impact the valuation? Rather than if I change my weighted average cost of capital, well, that's just an assumption. That has nothing to do with what the business is actually doing, how it's actually performing. So focus on lines above the free cash flow line when you're displaying the sensitivity analysis. This is, oh my God, it's so important. Please, 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 please try this, because it will really focus on valuable content that you deliver to whoever you're presenting, okay? So a quick overview, the 4 common mistakes investors need to be aware of when building a DCF model are: 1, building out a model with a forecast period, which is too short, so you really need to extend it out. 2, incorrectly projecting the continuing value estimate. So make sure that you're not assuming long-term growth, because research has shown that over the long term, you're only earning the fair rate of return. Number 3, there's a clear mismatch between investment needs of the business and earnings growth. So insert that ROI line and check if my projections make sense relative to the historical performance of the business. And go back not 4 quarters, but 8 years if you have that data. And the 4th one is incorrectly displaying the sensitivities of the model. So focus on value drivers rather than the long-term growth rate and the weighted average cost of capital. Other than that, I hope this video helped a lot. I wish I had this video when I started learning about the DCF model, because it's very, very important. If you have any questions, and please comment below, and I'll be sure to get back to you as soon as possible. If you like the video, please subscribe to the channel for more. I really like making these videos, and I just want to know that I have that support from the community. Thank you so much, guys, and see you soon.